Welcome back. All right, in conversation with the management of Ujjivan Small Finance Bank on, of course, earnings. Their retail business is gaining momentum as well. Disbursements are back to pre-COVID levels. Nitin Chugh's joining us. Nitin, good to have you with us. Let's talk about these numbers. What led to the muted NII growth this quarter, however, and the profits actually coming in lower this time around?
So this quarter, while we built the business back, starting December, we were also keeping a sharp eye on all kinds of stress which was emerging in the portfolio after the first 3 months of the moratorium post-moratorium period got over in the month of November. And while we were overall improving our profitability with the increase in business, we did take a call, and I think it was a bold call to estimate the credit losses for future and upfront and take all the provisions itself in Q3. So that's what we've done. Now, coming to specifics, I think the NII has not remained largely unchanged on account of the capitalized interest on the moratorium period. And since we don't charge interest on interest, it becomes a non-earning book for us. So it's mostly arithmetic. And for that reason alone, I think the NII did not move up as much. In any case, the book is also more or less, we've grown by 0.4% over the last financial year on a year-on-year basis. And now we are, in the last 2 months, we are pushing the pedal on growth. And by taking these kind of provisions, we are reasonably sure that, we don't have to worry about the credit losses anymore, and we can clearly, focus back on building the book now.
Okay, what's the outlook on retail loan growth and disbursements here seem to be outgrowing the rest of the book as well?
So we have quite a few lines of businesses. The ones which are a little older and stable, other than microfinance, is affordable housing and MSE loans. So those, in fact, we've been able to deliver our ever highest numbers in January itself. So we are clearly back on the path to grow both these businesses. As you know, the demand for affordable housing as well as for the MSE credit has indeed come back after effects of COVID. And we are just trying to cater to that demand. In the meantime, while we had this chance to, go slow in the first half of the year, we've also prepared ourselves through our digital workflows, our partnerships, etc. So all of that is playing out now. And these two businesses are obviously going to grow a lot more for us in the next financial year and even in this quarter. Other than this, we also do personal loans and vehicle finance, which even though they're early stage in their life cycle, we are expecting these two businesses to also scale up in the next financial year. And we are trying out a few new products, for example, gold loans. And that is again something that we would be introducing at scale in the next financial year. So I think it will be a fairly balanced approach between microfinance and non-microfinance. Retail obviously would be an area of thrust for us.
Sure. Apart from retail, wanted to understand how are the other loan segments performing in terms of growth?
So we cater to the mass market, as we call it, which is the lower than the affluent class of customers. And the same thing reflects even in our business customers, where we so far have been dealing with the informal and the semi-formal segments, which were indeed more impacted than the formal segments because of COVID. We want to stay focused on that segment, but at the same time, we're also building capabilities to serve the formal segments. Because as you would have noticed, our cost of funds has come down very nicely and it continues to come down. So we have the ability to price ourselves a lot better and be able to cater to maybe the low yield segments where the risk-based pricing is lower than what it would have been in the other segments that we've traditionally catered to.
Right. When it comes to capital adequacy, post this P&L loss, more than sufficient for growth and stress in the near to middle term. Also, we know that it's much higher than the peers at about 27%. But if this level of provisioning actually continues, could it be a need to raise more funds down the line?
Oh, yes. Our capital adequacy till Q2 was 31%. And now with the provisions that we've taken, which resulted into a P&L loss that we reported for the third quarter, the capital adequacy has come to 27%, but it is still way in excess of what the regulatory requirement of 15% is for small finance banks. So we are not worried about capital. And since we are back on our growth curve, the overall growth trajectory, we have enough and more capital for that. And in any case, we are not worried about raising any more capital because 27% is extremely healthy to have as capital adequacy.
Okay. Okay, you're also gearing up digitally, Nitin. What's been the traction here? Is it helping you access more regions? What have been some of the benefits there?
So we've been working methodically on our digital strategy. It's broken into 3 or 4 parts. The first one is that how do we improve our own workflows? How do we digitize ourselves as a bank, which is where we have improved a lot through robotic process automation and a lot of workflow digitization in partnership with a few fintechs, to the extent that turnaround time for a lot of processes have actually reduced by 50 to 70%, which we also reported in our earnings call yesterday. The second thing is that we're also opening up a whole lot of APIs. We are very bullish about this whole API banking. We've released about 90 out of the 150 APIs that we're working on, which is helping us in partnering with fintechs. And these fintechs are helping us with collections, they're helping us with distribution, they're also helping us with workflows. And the last thing is that in this whole process, we have also digitized our entire set of workflows in the bank. So all our onboarding now, whether for assets or for liabilities, is all through digital. And now we are on a roadmap to also bring in artificial intelligence. We made a small beginning through a chatbot on our website, but we have a full roadmap for digital as well. So I think digital is going to really keep us ahead of the market in many and many more ways than what we have already delivered. And you would have noticed that our digital transactions, which we have been encouraging our customers to take to, that has also been increasing every quarter. Last quarter, we reported 59% of our transactions as digital, which a year ago was only 33%. So all in all, I think our digital strategy is playing very well, and it is going to give us a big competitive edge in the market and also a much better experience for our customers.
All right, Mr. Chugh, thanks so much for joining us and taking us through the earnings this time around.